During the 3 decades following India's independence, 1950s, 60s and 70s, India's growth rate was very poor. GDP grew at a very low rate of 3.5% annually. This was also the period of explosive population growth of around 2.3% a year. Consequently, per capita income grew at a measly 1.2%. Poverty was widespread, consumption was very low, and economic policy was not business friendly. As a result of all these, corporate earnings were very poor and the stock market performance also was very poor. During these 3 decades of 50s, 60s and 70s, stock market returns did not even cover inflation. The situation changed in the 1980s. In the second half of 1980s, we had the first dose of liberalization in India. So as a result of all this, the economic growth rate, GDP growth rate moved up to 5.6% a year. And for the first time, the stock market performance was a very attractive performance, outperforming all other asset classes and beating inflation. The picture changed dramatically after 1991. From 1991 onwards, India started implementing economic reforms with far-reaching consequences. The policy of liberalization, privatization and globalization completely altered Indian economy. This period also saw a decline in tax rates. Both personal income tax rates and corporate income tax rates were reduced during this period. As a result of all this and the high growth rate that we achieved since 1991, the investment scenario completely changed. If we take the period 1992 to 2018, India's GDP growth averaged 6.86% a year. This is the second best growth rate, second only to China. Therefore, after 1991, India's GDP growth, because of this sharp improvement in growth rate, India's GDP multiplied by more than 10 times. And the stock market, as measured by BSE Sensex, multiplied by more than 38 times, from 1,000 to 38,000 as I talk presently. If we take a longer perspective, the last 40 years, for instance, from 1979 to 2019, the stock market has multiplied 380 times, from 100 in 1979 to about 38,000 now. So this actually translates into an average annual return, CAGR, compound annual growth rate of more than 16%, and this is a very attractive rate of return, beating all other asset classes by a wide margin. So this has resulted in phenomenal wealth creation through the stock market, and those who invested in stocks and equity mutual funds, those who invested in stocks very intelligently, participated in this wealth creation and made a lot of money. Now, what is the scenario going forward? Now, there is a global consensus that India will be one of the fastest growing large economies in the world in the next many years. Already we are the fastest growing large economy. Presently we are a $2.5 trillion economy, and the consensus is that we might be a minimum of $7.5 trillion economy by 2030. It's only 12 years away. So if when India's GDP multiplies from 2.5 trillion to 7.5 trillion, we may even exceed that. And when India's market cap multiplies from 2.2 presently to around $7 trillion, phenomenal wealth creation will take place. The best way to participate in this wealth creation is by investing in stocks. Indians should participate in this wealth creation, and there are 2 ways by which you can do that. If you have the expertise to invest in stocks directly, invest directly by buying good quality stocks. If you don't have that expertise, invest indirectly through the mutual fund route, preferably through systematic investment plans. So benefit from the India growth story, participate in the India growth story by investing in stocks and equity mutual funds. Thank you.